Good evening, ladies and gentlemen. It's 1 minute past 5 in my on my computer here, and I guess we can start our session for tonight. So, how have all of you been doing today? And Nadine, you're saying I really want to thank you for putting up the yes, Nadine, no problems at all. That is my primary responsibility to take care of you. You are all my pupils, isn't that so? So, I would do all that I can, whatever is possible for me to contribute towards your success, because as a teacher nothing makes you more happy than the success of his pupils. So just take care that you do well in your course and in your exams and then in your life. um, you were going through FM2 last evening and things I didn't get in class clearly. Yes, of course, that's the advantage of the recordings. Yes, that is true. You can always revisit. Well, thank the Lord for technology. I mean, I can imagine. I still remember some of my frustrating days when I was a student at the university. There was no such technology. Yeah, so not even financial calculators. Can you imagine that? We all had to learn time value formulas, and even, if we had to calculate the log or anti-log of something, we had to use the old way of looking at the tables, log tables and anti-log tables. So the benefit, of course, of that was that we learned everything from the first principles. So we are not handicapped in a sense that, I mean, if there is no calculator, oh Lord, what's going to happen? So I'm not going to feel lost in that sense. So with everything, there are pros and cons, I believe. You're saying, I really hope it stays that way, as you know. It is alleged. Alleged is a very heavy term, isn't it? FM2 is not for the faint-hearted. Uh, well, not for the faint-hearted, but as I said that day also, I mean, there's nothing that is beyond human capacity. So I guess if you remain committed and disciplined, there is nothing that you cannot achieve. Absolutely nothing. Right, let's come back to money and capital markets, though, because this is supposed to be a session for money and capital markets. Folks, so how has been your week? Have you been able to source a textbook? Have you been able to go through the my e-learning course page and get the materials that you need? And I saw that about 9 people participated in the first tutorial sheet as well. I am encouraging others to do that as well, because there's just one question in the first tutorial sheet, only one numerical question, that is. A couple of you did not get it right, but then you would have seen the correct response. And even if after that, if you don't understand that why that response was the correct response, you can write to me and I will explain it to you. Right. So, anything that you will want to share with me before we start for tonight? Anything interesting that happened during the week? Well, you didn't go out somewhere, I guess, because going out is not an option these days. Did you eat something that is to your liking? Did you talk to an old friend, maybe? Did you get time to read the stuff that was discussed last week? Um, are there any problems that you would like to ask? Are there any questions from the last session? Though it was just an introductory session. So I'm just going to give you a few seconds to collect your thoughts. Should you want to ask me anything, and then we will begin our journey forward for tonight. So no questions coming through the mic or through the chat box. Rivaldo, yes, Rivaldo, you would like to say something?
Hello.
Yes, Rivaldo, I can hear you.
I heard in one of my classes earlier about a bank in the UK. I think it's HSBC. They had a fiasco recently about suspicious transfers, something built upon the scheme. I was wanting to know if you had any information on it, or what is your perspective on it?
It hasn't come to my notice as yet, but I'm going to look for it now that you have mentioned this to me. But I was actually going to talk about HSBC. I was going to use that as an example tonight, but now that you are telling me something went wrong, something went suspicious with it, I'm my interest is really intrigued. So after this session, I'm just going definitely there to look for that information.
Okay, no problem, sir. Thank you,
Yeah,
sir.
yeah, no problem. Anyone else? Mario, you're saying HSBC has been involved in illegal activities. Oh, yes, there are many stories. Um, that is always the case with the financial sector. That's why I don't know. We were saying this in the FM2 session the other day. It's very important that as the younger generation joins the public offices and private offices, they not only keep wealth maximization as their supreme most objective for the firm's shareholders, but to do it in an ethical way, which is all inclusive and takes care of the community in general, would be a much better way to enhance the well-being and welfare of the society and the economy in general. Mario, you're saying money laundering amongst other things. Yes, yes. That's how all these terrorist activities and everything, all the black markets and the hawala markets. I don't know whether you've heard the term hawala or not. They are all financed through the money laundering thing. CFA program started showing emphasis on ethics. Well, high time they started doing that because it's not all about money in this life. There are some basic principles, basic rules of conduct to live by, and if you are adhering to those rules of conduct, then money will be beneficial for you. Otherwise, the same money can be very, very harmful. It's just like I guess anything like nuclear energy. You can do good things with it, and you can destroy the whole world with that as well. It's about human motivation and human will, what we want to do with the resources that we have. The resources in themselves are neither good nor bad. It's all about the human. People discuss a lot of things like which system should be good. I mean, capitalism is good, or communism is good, or socialism is good, or a mixed economy is a better way to do things. Well, I guess my personal opinion would be that all systems are good. There are no wrong or right systems. There are only people who can be right or wrong. If you are following a system and deploying it conscientiously with ethical conduct, I mean, I guess every system can work well for humankind. So I guess you are the torch bearers because, well, I'm going to be what 52 this year, and then I'm now beginning to count my days towards retirement. Another 12, 13 years maybe, and then I'm going to fade out. But you have a long, bright future ahead. I guess you will take this planet towards a better future as compared to what we have experienced for the last, what, thousands of years maybe. And I wish you well in that pursuit. Okay, folks, what we discussed last time was that we had an introduction basically. There was one question that we were tackling, and that was why we should study financial markets and institutions. And we started last Monday by saying that financial markets and institutions would be important because they play an important role in keeping the economy healthy by making it change hands regularly. And then we said that we came up with a broad term. We said that it's the financial system that ensures the flow of funds in the economy, and then the financial system, how it would be comprised into its two parts, markets and institutions, where we said that the markets had a mandate to channelize the funds from point A to point B, and financial institutions would serve as the connecting links. We also mentioned that point A would be somebody who would play the role of a saver or a lender, and point B would be someone who would play the role of investors or borrowers. We also made a mention of the fact that when the funds need to be transferred in the financial markets and through the financial system, it's not that people are going to go into each other's homes and offices and borrow or lend funds. Instead they are going to create a tradable item which can be purchased and sold, and that tradable item, we gave it a name. We called it a security or a financial instrument. And then we went on to define what is a security or a financial instrument. We said that a security would be a legal claim on the issuer's future income or assets, And then I gave you an alternative definition which used kind of a funny word, fungibility. We said that fungibility means similarity between units of the same commodity, and that if you were to define a security in that context, you could say that securities are fungible, negotiable instruments which have a financial value. After doing this basic stuff, we looked at some very basic features of the bond market, stock market, and the forex market. Like for example, we defined what a bond would be, and then the fact that it would be traded in the bond market, and that the price or rental for borrowing the money through a bond would be called interest. And then we remembered that bond prices and market interest rates are inversely related to each other. We also defined what a stock would be. We said a stock would be a security that would represent ownership rights in a company, and that they would be traded in the stock market. And because out of all the financial markets, it is the stock market which gets most coverage, and it is the most exciting place because stock prices are most volatile, most volatile variable in the financial market. Therefore, whenever somebody thinks of a financial market, they simply start thinking about a stock market. In the context of foreign exchange market, we just mentioned two basic definitions. We said that a forex market would be where one currency is converted into another for the purpose of transfer of funds between countries, and that the price of one currency in terms of another would be known as the exchange rate. We spent a little bit of time towards the end of the session on financial institutions, where we said that they serve as connecting links or intermediaries, and they help in making the financial markets work. We listed rather a few categories of the financial institutions. We mentioned the central bank, who was supposed to establish and administer the monetary policy of a country. And when we say monetary policy, we meant money supply and interest rates. And then we mentioned commercial banks, whose prime role was to accept, deposit, and make loans. And then other institutions, we made a mention of them: insurance companies, mutual funds, credit unions. By the way, in the United States of America, credit unions are known by an alternative name. They are called savings and loans associations. And the final thing that we talked about last Monday was some innovations in the financial sector, where we mentioned stuff like plastic money, credit cards, debit cards, electronic fund transfer, phone banking, net banking, various apps that can help you to conduct your financial business on your smartphone or computer. And then we ended it with something known as an e-wallet, like a PayPal. And I told you that ViPay is a company that might start offering e-wallet services in Trinidad and Tobago. Right. So this evening, ladies and gentlemen, we are going to continue in the same line of thinking, and we are going to extend our overview of the financial system a little deeper. We are going to add a few categories to our discussion. Like, for example, in the beginning, we are going to focus on financial markets, and we are going to look at these three agenda items that you see on your screen. We are going to just briefly mention, because we don't need to now talk about it, we are going to just mention what are financial markets, why they are needed, and then we are going to go straight into the classifications of financial markets, because financial markets can be classified based on different criteria. And then towards the end of this particular section that deals with financial markets, we are going to look at some securities, their international versions. For example, if you know what bonds are, then if you issue bonds internationally, then what various names they can carry, and what the meaning of those names is going to be. Like, for example, if a company in a particular company would like to borrow from the international market because it believes that its borrowing capacity has been exhausted in the domestic market, so if it is wanting to go international, it can think about issuing international bonds, and those international bonds can be then broken into different categories. For example, we can call them foreign bonds. We can also call them euro bonds. And then there is a concept of euro currency, which you will look at when we get to that point. But before that, because we are just starting this particular session, let's review our definition of financial markets and why they're important. We said before last Monday that financial markets are mandated with the task of transferring funds from point A to point B, where people and businesses at point A would have lesser investment opportunities as compared to people and entities um, at point B. So, somebody standing at point B would be in urgent need of funds to carry on with their investment opportunities, whereas someone who is at point A would primarily play the role of a lender or a saver. And financial markets, as we noted last Monday as well, would play a vital role in improving the economic efficiency by helping us in making timely use of economic opportunities. Towards the bottom of the slide, you can see a few examples of how economic efficiency stands to get improved through this constant transfer of funds from one point to the other. For example, increase in production, helping somebody to earn interest on their funds, which otherwise would just remain idle, or helping someone in purchasing an item now and paying later, because somebody, even if you don't have the money, you can participate in the financial system, and then that will help you to procure a loan, which will help you to purchase an item right away, and then you can go on paying for it later through your monthly installments. Whereas if there was no financial system existing, then you would have to save all the money and you would have to wait all those years till you would have enough money to buy that particular item that you want to buy. And by that time, maybe the time for enjoying that article would have passed already. So this is broadly what financial markets are supposed to do. And how do they do this? We are going to look at that through when we see the classification of financial markets. So let's delve into that straight away. Ladies and gentlemen, when you decide to classify financial markets, that is, you want to break it down into its components, then there can be various criteria that could be used to do that. For example, you are seeing one of those criteria on the title of this slide at the moment. You're seeing that we are going to classify the financial markets on this slide according to the type of security that we are thinking about and the time that particular time for which that particular security stays alive. And then we are going to change the criteria on the next slide. We are going to classify the financial markets according to issue. So stay with me to understand this better. So according to type of security and tenure, we can say that we can have what we call debt markets. And then when we start thinking of debt markets, we can classify them into two parts. Again, short-term debt markets or long-term debt markets. What would happen in a debt market is that debt-related instruments will be purchased and sold. So, for example, bonds would be purchased and sold in the long-term debt market. And that would be, if you will remember from last Monday, that would be a part of the capital market because long-term financials take more than 1 year to mature and would be a part of the capital market. On the other hand, short-term debt-related securities, you could think of some examples like treasury bills would be one such example, or you could think about a certificate of deposit. That is also a short-term debt security. You could also think about what is called a commercial paper. That's also a short-term debt security. All these securities mature within a period of 1 year or 12 months, and therefore these securities would be traded on the money market. Continuing with this classification, you can have equity markets, which would deal with trading common stock. And for common stock, we do not have any defined tenure. We cannot classify it as short-term stock or long-term stock because the tenure for common stock is indefinite. Maybe I mentioned this last time, or maybe I didn't, but I'm still going to do that for your benefit, just in case, that when we create a share of common stock, it really does not die per se. Only the ownership can keep on changing, because person A can sell their common stock to person B can sell it to person C, then to person D, and so on. The membership or the ownership of the stock can keep on changing, but the stock itself survives over a long, long period of time, unless, of course, and I don't know whether you have heard about this, unless, of course, the company which issued the stock itself decides to repurchase the stock and bring it back into its treasury. When a company does that, we say that the company is going to repurchase or buy back its stock, which will mean that it will call the stock off from the market, and which will also have an effect of reducing the number of outstanding shares in the market. Only when the company decides to repurchase its own stock does a stock temporarily disappear from the market. Otherwise, it goes on circulating and only keeps changing hands. That's why common stock would not have any defined tenure. And for that reason, common stock would belong to the capital market, not the money market. The second way through which we can classify financial markets would be according to issue. And when we think in these terms, we can think about two types of markets. We can think about the primary market, and then it follows that if one of these markets is going to be primary, the other will have to be necessarily secondary. So what happens in the primary market, you may have read about this earlier as well, maybe in FM1, that new security issues are going to be sold to initial buyers of the securities through a process known as an IPO, the initial public offerings. And this is going to be done with the help of what you see there highlighted in red. It's going to be done through investment banks. And this is where I wanted to mention HSBC, Citibank, Morgan and Stanley. These are all banks which play investment bank roles as well, apart from their commercial bankers, so banking services. Ladies and gentlemen, from the chat box, I would like to know from you whether you have ever heard about an investment bank and the fact that they underwrite the issues. Also, I have been speaking for a few minutes now, and it seems that there is a complete silence all around. Would you like to say something or ask me something at this particular point? Something that I've just spoken out and went on, and maybe it did not make sense to you, and you would like me to repeat or explain again, or something that you heard for the very first time and I went too fast with it, and you didn't have enough time to gather your head around that. Maybe you could ask. Jared, you're saying you have heard of an investment bank. Good. So, Jared, can you tell me, is there an investment bank in Trinidad and Tobago? Uh, Nadine, you're saying, sir, because you had to purchase the IPOs via the FCB. Whose IPO, Nadine? FCB had their IPO. So some banks would have helped the FCB again in selling that IPO to the public, though FCB in itself is a bank, but they would have taken the help of underwriters, quote unquote, to help them sell those shares to the public for the very first time. Um, I don't know if I have something you mentioned, FCB. Just give me a second if I have their initial public offering. Um, yes, FCB Answer Merchant Bank, yes, and then there is Citibank as well. Just give me a second. I'm looking for FCB's IPO uh, advertisement. Hmm, yeah, so just give me a second here. I'm trying to find the FCB IPO. Looks like I found it somewhere, but is it really readable? Right, so let me see if I can change the sharing. Share application screen. So I'll have to stop sharing this, and then so now I don't know if you can see. This is the initial public offering advertisement from the First Citizens from way back. Let me try and zoom this a little bit so that you can see this. So you can see it's was an offer of sale for some ordinary shares having no par value at $22 per share, payable in full on application to be listed on the Trinidad and Tobago Stock Exchange. And then there are subscription details and allocation details there. Um, Let me just move the picture around so that you can see how this looks like. So subscriptions details, it says the offer for sale has received 12,435 applications for these many ordinary shares, resulting in an oversubscription. So a lot of people expressed their interest to purchase these shares first up from FCB. So the offer was oversubscribed in entirety with total subscription of these many dollars. Any surplus shares that were available from any other investor type category was reallocated to individual investors who are nationals of Trinidad and Tobago until all of the excess shares were fully allocated. So you see investor type categories here. Some shares were reserved for the employees of the issuer, some shares for individual investors who are nationals of TNT, then some for the registered pension and other trust funds, credit unions and cooperatives, some for NIB, like that. There's a breakdown. Right, so there is some more information towards the end. This was the advertisement from First Citizens. Um, Let me go back to the PowerPoint. Right, so we were talking about at that point in time investment banks, and you had responded by giving some examples. Nadine's was the last comment about NGC shares. Yes, investment banks, ladies and gentlemen. I'm giving you alternative terminology here. Investment banks are also known as merchant banks, just so you come across another term for it. So maybe if you have your writing material handy, you can write that down. Investment banks are also known as merchant banks. Also, many commercial banks that we are aware of in Trinidad and Tobago also, they do commercial servicing activities, commercial banking activities, but they also have their investment banking division through which they provide underwriting services. So what is this underwriting thing? Because when we mention this term underwriting, we can think about the insurance business also. In that business, the meaning of this underwriting would be different, but in this context, underwriting would mean helping out the original company in selling its shares and assuming the financial risk of selling the shares to the final retail investors who will participate in the IPO. So how does this work? Let me, for a moment, end this slideshow here and insert a blank slide for you, and then we can use the pen and where I can explain that to you a little bit. I'm just trying to make sure that what I'm doing is visible to you. So what's going to happen here is, let's just take an example. Let's say company A company A wishes to sell some shares. Let's say it wants to generate $20 per share by creating new shares and selling them out to the public for the first time. So the management of company A has two options now. They can stop doing their core business, whatever they are engaged in doing, and get bothered with trying and selling these shares out there to the public, or they can outsource this activity. They can get in touch with the underwriters or the investment bankers and ask for their help. So if that happens, then they are going to approach the investment bank. So the investment bank here becomes, if your mind is alert, you will realize the investment bank here becomes an intermediary, a connecting link. So the investment bank tells company A, look, if you have, let's say, a block of 10,000 shares to sell, 10,000 shares to sell in all, if you have a block of 10,000 shares to sell and you want to sell each one of them for $20 a share, all right, what we are going to do for you is that we are going to buy this entire block from you. So we are going to purchase this 10,000 shares and pay you $20. So company A is going to receive 10,000 multiplied by 20, these many dollars, right? And then the investment bank carries this 10,000 shares, this whole block of 10,000 shares, and bears the financial risk of reselling it out there to the public. How it will do is that it may get in touch with other investment banks also. So maybe this is investment bank one, I'm writing IB1 for that. Maybe this is investment bank two. So more than one investment bank can participate in the selling process. So maybe this is investment bank three. So now they share the risk of reselling this amongst themselves so that the entire onus doesn't fall on one investment bank itself. What we call this group is known as, this thing is known as I'm just creating this arrow here and writing it here. This will be called an underwriting syndicate. This information may not be there in your textbook, so you can revisit the recording and refresh your memory about it. So the original investment banker getting in touch with a couple of others, they form an underwriting syndicate to spread out the risk of reselling the shares. What is the risk? The risk is that, well, we now have 10,000 shares to resell, and the public may simply not be interested in buying all of them, whereas we have already paid the price to company A for these shares. So if some of this stuff now remains unsold, then we will have a problem on our hands, because it's simply like it's a chain. Like if you consider company A here as the producer, investment bank an investment bank would act like a wholesaler, and then you can come down to retailers. I'm out of space here probably, but they are going to get in touch with what we call brokers. So I'm trying to write the word brokers here, local brokers in the market, and through the brokers they are going to go to individual people. So these are the final customers here, final customers, final cust. So let me insert another one here and make it a little neater for you. So from company A, let me get back my pen. So from company A, the shares move to the original investment bank, right? So they get 10,000 shares by paying a price of $20 per share, and then they form an underwriting syndicate. I'm writing just U and S to indicate underwriting syndicate, and then they get in touch with local brokers. So I'm just writing BR for brokers, and through them the shares are distributed out there into the market in the general public. But then as you go on adding various channels into this selling scheme, so now the underwriting syndicate here is going to share something, because they are not going to do this for free for the original investment bank. So the investment banker thinks to himself, the guy here, this one is thinking, look, I paid $20 to buy a block of these shares, so I'm going to offer it for sale, so let's say for 21. So out of this 21, the underwriting syndicate, those three banks that were there, three other investment bankers who were here, they will share a little bit. Maybe they will keep they will keep one, let's say about $10 each, right? And then it goes to the broker. The broker says, I'm going to keep $2 per share for myself. So how much is it going to cost to the final person? So here is you and me, how much we are going to pay for this share, right? What do you think? What will be the price for us? Any response? Are you listening? Ruben, you're saying 33. Let's check. Not more than $21. So the underwriting syndicate wants to keep $10 for itself. Brokers want to keep $12. So in setting their selling price here, how much price should the investment banker here set to sell the shares? 20 it paid already. 10 these guys will take away. 2 these guys will take away. And then this investment banker has to make some profit as well. So 20 is the cost, plus 10, 30, plus 2, 32, right? $32. So they might want to keep this price here at, let's say, $34. Out of this, 10 will be taken by these, 2 will be taken by these. And you and me will have to pay $34. So we pay 34, 2 are kept by these people, 10 are kept by these people, what remains is kept by these people. And the company gets $20. Right? So we pay 34, out of which the broker keeps 2. So what remains? 32, out of which 10 are kept by these guys here. So what remains? 32 minus 10, 22. So these guys get to keep $22 here, and their profit would be, therefore, they get 22 by purchasing the shares from company A for $20. So their profit is $2 per share. Yeah. And the final cost to the consumer would be $34 per share. Does everybody have a question about this? Do we all understand this? Ladies and gentlemen, please clarify if you have doubts, if there is something which is not understood. Yeah, so far it's clear to you. What about everyone else? Are you listening to me carefully? Okay, okay, great. All right. Shena, you're saying that the price can be set at more than 34. Yes, of course, it can be, depending upon the market popularity of the company, how much the final consumer will pay. Because when you're selling something, you have to keep in mind, you and me, isn't that so? How much the people here are going to be willing to pay, and that would come through the market forecast. What's the maximum price the final consumer is likely to pay? So that's going to determine what the price will be that will be charged by the investment bankers, and what would be the margins retained by the underwriting syndicate and the brokers. So the price you and me, that you and me are willing to pay will determine that. So, ladies and gentlemen, tell me one thing. There's an interesting term that will come out of this analysis. Look, you and me are paying $34 here, but what is the company which originally issued the shares getting? $20. So there's a whole lot of difference between what the company gets and what the final investor ends up paying. There's a difference of $14, isn't that so? So let me erase some of the material here and write for you a very interesting term. You will come across this term later when you read about the stock market in a later chapter. So this difference, because you and me, that is the final investor, we pay 34 and company A gets 20, The other $14 are lost in translation somewhere. There is a formal term for this. I'm going to write the abbreviation for that and then speak out the full form because I don't think I have enough space to write all of that. MLOT. It stands for money left on the table. So for engaging the services of investment bankers or merchant bankers, company A would have to be willing to keep $14 on the table itself, money left on the table. So out of the $34 per share that were raised from the general public, the company leaves 14 on the table and takes away 20 with it. Do we understand? So this term here is an interesting term, money left on the table, because you have chosen, as company A, you have chosen to engage the services of intermediaries in the form of investment bankers or underwriters or merchant bankers. You can choose to call them what you want. Ladies and gentlemen, are we okay? Should I proceed further? Okay. Right. So we have said so far, we have looked at the primary market, and the fact that one of the markets is primary means that the other variant of the financial market would have to be secondary in nature, where securities that have been previously issued. Now, stop here for a moment. What does it mean by saying previously issued? Previously issued means the ones that have been issued through the IPO, initial public offering, in the primary market. So in the primary market, some shares were sold to the initial buyers. I'm continuing to say shares, but actually what I mean is securities, any security in general. It could be a bond as well. So once the securities were created and sold in the primary market through the IPO to the initial buyers of the securities, then the subsequent trading of that is going to take place in the secondary market. That's what it means. Ladies and gentlemen, at this point in time, I would like you to apply your mind a little bit and try and answer a very simple question. And that question is, what is the need for the secondary market? In other words, what would happen if there was no secondary market at all? Do you have any ideas about it? You can share with me through the chat box, or you can speak to me. The company created and sold some securities to the initial buyers through the IPO. They got their $20 from there and they went home. What is the need for a secondary market? And who would participate? Would the issuing company participate in the secondary market now? Yes, Mario, you want to say something?
So, well, since stocks don't have a due date and it would
Mhm.
be like regular people buying it, so they would trade amongst themselves in the secondary market.
That is so true. Yes, thank you, Mario, for that input. And Nadine, also, you said if people wanted to sell their shares. So I'm taking a cue from you, Mario and Nadine, and I'm saying, why would people want to sell their shares then? If they wanted to sell them, why did they buy them in the first place? What was the need to participate in the IPO and send in an application and send a check and then, okay, investments is the reason. Yes. So everybody who is purchasing securities in the financial market is doing that for the purpose of increasing the value of their money over time. So Ruben is saying to profit of the popularity of the IPOs. Rivaldo, you're saying they lose confidence that the value will increase. Right now, FCB shares which were bought for 22 are now valued 45. Yeah. So I guess you have an idea of where this is going. So yes, Ruben, it's more than double of what it was issued at. Um, I hope it's not an angry woof, like woof. Okay. Um, I was also about to. I'm tempted actually to introduce another term to you, but I don't know whether I should do that. I'm just debating with myself. You would realize that not only with the FCB, but I also remember the case of Facebook when they first went public. I think they floated their shares through the IPO in the primary market for I think about $14 or something. And by the time on the same day it hit the secondary market for trading, the price went up to 41 by the end of the day itself. So, ladies and gentlemen, the term that I want to tell you is that if the company sells the shares to the public in the IPO for whatever price, and in the secondary market, if the price increases later on, then we say that the original issuing company deliberately maybe underpriced their issue. Underpricing, please remember this term. Companies many times will consciously, deliberately underprice their issues. Why would they want to do it? Why would you want to sell your product for a price that is actually lower than what it should be? Maybe the Facebook people also knew that the real worth of the share once it hits the market is around 30 or $40. To quickly gain capital, who will gain capital, Ruben? Please clarify this to me. This is important. Who will gain capital? No, 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 no. Ruben, please remember, if Facebook, for example, sold their IPO for $14, that is the $14 they are taking home with themselves. If the price at the end of the day in the secondary market trading went up to 41, Facebook is not getting a single dollar out of it. Mario's reason is more correct. Uh, Companies would deliberately underprice their IPOs to make sure that all their shares are subscribed and all the shares would be purchased by the yes, share, attract buyers. Uh, that's a good way of expressing that, to encourage more persons to purchase. Yes. So keep it cheap so that it sells off fast. Simple economic logic. No rocket science there. So now let's come back to the primary market. You have mentioned to me that secondary market should exist because it will allow people to sell off their shares. And then I asked you the question, why is it that people would want to sell off their shares? Because if they wanted to sell them off, if you don't want to keep something with you, then why buy it in the first place? Then your answer was because you may want to make a quick buck on it. You want to end up in a profit making situation. And how can that happen? Let's say if you purchased your stock or a security for $14 in the IPO and the price then went up to $40, now you see a clear profit making opportunity. You can sell off the share for $40, and the difference between 40 and 14 would be your gain. Ladies and gentlemen, gain, please remember, listen to me carefully. This gain that you have just ensured for yourself is known as capital gain. Capital gain. So if someone asks you tomorrow, define capital gain, your answer should be very quick and smart. You should say capital gain arises because of the difference between the selling and purchase price of a security or any asset. So if the selling price is greater than the buying price, it results in a capital gain. My question is, can there be a capital loss? And the answer to that is yes, there can be a capital loss as well, because if you purchase the shares or securities for $14 a piece and the price went down to 10, and for some reason, if you had to do a distress sale and you wanted to get that money, just buy HSBC shares. Okay. Yeah, I get you have a good sense of humor there. Good to have that, especially in these difficult times. Um, right, so what was I saying? I kind of lost the train of my thought. Yeah, sold at 20, now valued at 16.
So you were talking about capital gain
Mm-hmm.
and loss.
Yeah.
That's very good. Yeah.
Okay. So there could be a capital loss also, for example, just in case we had an example just now where Nadine was saying the NGC shares sold at 20, now valued at 16. So this is if you are now going to sell off the share, then it will lead you to a capital loss of $4 per share. Right, but the ultimate intention in the secondary market is any participant in the secondary market wants to be able to sell off the shares which they initially purchased through the IPO. And are they going to be able to sell off their shares? The answer to that question is, are there people who are willing to take the other side of the transaction? What would be the other side of the transaction? And that other side is the buyers. Are there going to be buyers? Of course, people who missed out the party in the first go, they did not participate in the IPO and then started realizing that, oh, look, this share was issued to the general public for about $14, $15, and now it has gone up to $40, $50. Maybe I missed the bus at that particular time, but now I should get onto it, and I'm willing to purchase these shares. But what to do? The company is no longer selling any new shares. So the only way for me now to get the shares is to find somebody in the secondary market who is looking to make a profit. So if you are willing to sell your share to me for $50 and I want to get on the bus as well, so we are going to meet and there's going to be a transaction. You're saying FCB issued a second IPO and shares were sold at I think 30 something dollars and people still bought them. Yes, of course they would, Nadine. There is no limit to how many number of IPOs a company can do. Company, if you will recall from your accounting courses, they will have something known as authorized share capital in their balance sheets. So, for example, the memorandum of association of a company will allow them or empower them to sell, let's say, a total of 100,000 shares, but it is up to the company to sell those 100,000 shares all in one go or sell them as and when they need, when they feel the need to raise equity capital. So maybe at the moment, my need for equity capital is not that much. So out of my authorization of 100,000 shares, I, as a company, decide to simply sell a block of 10,000 shares through an IPO. Later down the line, I may come up and sell out another block of maybe 20,000 shares through a subsequent IPO later on. So a number of IPOs can happen over the lifetime of a company. So secondary markets, ladies and gentlemen, are going to allow these buyers and sellers, subsequent buyers and sellers, to come together and transact their business. I'm going to show the next sentence to you, and some part of the sentence is highlighted in red, and I would like to invite your opinion on that. What you read is secondary markets exist because they discharge a very important function, and that is that they promote liquidity, and liquidity makes the securities more desirable. What do you make out of all this? What is liquidity and why, because of having liquidity, securities would become more desirable? What is your feeling on that? What is liquidity? First things first. Liquidity. Easily converted to cash. That is correct. Liquidity, all current assets, for example, in your balance sheet are liquid, more liquid than the fixed assets because they can be easily converted into cash. Mario, what I would like to add to your response is that in this case, in the case of securities, liquidity would mean that not only the securities should be easily converted into cash, but we should be able to do that quickly and easily convertible into cash. So what it means in this context is that, for example, if I participated in the IPO and purchased some shares through the IPO, now I'm looking to sell them for a profit to someone else in the secondary market. If I can do that, number one, and if I can do that very quickly, only then I will be able to convert my share into cash. Because how will my share, which is an asset for me, is going to get converted into cash? Only if I'm able to sell it to someone else, because then I will hand over the share and collect cash for it. So the ability to convert my share into cash quickly and easily is what is known as liquidity in the context of a secondary market. Ladies and gentlemen, as potential investors in the financial markets, which shares or which securities would you like to go after securities which are more liquid or securities which are more illiquid. Illiquidity means difficult to convert them into cash, which means that if you happen to purchase that particular security, then you are going to feel stuck with it, because if you want to sell it off to somebody, there is no ready buyer for it. And even if somebody is willing to purchase, they are going to purchase it at a discounted price. So which means liquid shares are more valuable, and that is why they become more desirable. Remember this thing, because this is going to come back in the form of another question later on for you to consider and respond to. Right, so far what we have said that according to issue, financial markets can be classified into primary and secondary market. Secondary market, ladies and gentlemen, can be further subdivided into two categories. What are those? Number one, organized exchanges, and number two, the OTC market. Folks, OTC stands for over the counter. Over the counter. If you have not heard about this, I'm saying the full form of OTC again slowly. Over the counter. Over the counter. What are these markets and how they function? Let's have a look at them on the following slide. First up, we are going to talk about the organized exchanges. So a lot of reading material has suddenly popped up onto your display. Let's take it one at a time. What happens in an organized exchange is that trades are conducted in central locations through brokers and dealers. Now let's stop here and let me add a few things to it. If you have your writing material handy, or if you think that you will be able to remember this, or if you have none of these, then maybe you can come back to the recording later on. Then please remember, organized exchanges are tangible exchanges, tangible market. Organized exchanges are always tangible in nature. Tangible, tangible. What is the meaning of tangible? A tangible object is something which has a physical appearance. We can touch it, we can see it, we can feel it, we know where it is kept, and we can find our way to it, right? Just like that, an organized exchange is a tangible part of the market, where it will mean that it will have a tangible office, there will be a tangible building, a central location, it will have a one particular street address. You can get dressed, get into your vehicle and drive to that office and get your business done there. That is what a tangible part of the market will mean, that it will have one physical address where you would be able to go to. You could find it on the map. There will be a specific building there and somebody in the building to take care of your business. So in an organized exchange, trades are conducted through central locations which are clearly identified. That is what gives it the tangibility. Now, how are trades conducted? They are conducted through what we call brokers and dealers. Now, to be able to understand this part of the story, let's just simplify it a little bit. Let's say one fine day your friend suggests to you, look, what are you doing with the excess money that you have? Maybe you are at point a saver, and you have some idle money because you're saving some for the rainy day, or maybe you're wanting to meet some objective at a future point in time, so you're saving. And your friend says, or your relative says, what is that money doing lying there doing nothing? Why don't you invest some of it in the financial market? Let's go and buy some shares or bonds. Let's approach the financial market. So, ladies and gentlemen, once that desire arises in you that you're going to make use of that idle money and participate in the financial market by buying some shares or bonds, you are not going to get dressed and get in your vehicle and go to the Trinidad and Tobago Stock Exchange, for example, directly. You will not be able to buy and sell shares or bonds like that. The first thing you will need to do is that you will need to get in touch with a brokerage house, a middleman, an intermediary, like you see on your display, an agent who will work on your behalf. So you will have to get in touch with a brokerage house. So you go to a brokerage house. Let's say, for example, one of the brokerage houses here is Wise Securities, West Indies Securities. There are others as well. AIC Securities is one, JMMB Securities is another. There are a lot of examples of brokerage houses there. So, what will happen when you go to a brokerage house? Just like when you go to a bank and open a savings account or a checking account, when you visit a brokerage house, what's going to happen is that they are going to give you a form which you will fill and you will open a brokerage account. The difference between a bank saving account and a brokerage account is that whereas a bank account would contain only cash, a brokerage account can contain two things. It can contain not only cash but also the securities that you buy by participating in the financial market. So maybe you will open a brokerage account with a minimum requirement of, let's say, 500 or what $1,000 or whatever it is, and then you can then instruct the brokerage house through writing or through making a phone call, or by filling out a form, that out of the $1,000 that you have deposited in your brokerage account, you would like to use 200 of them to maybe purchase 5 shares of, let's say, Republic Bank Limited, right? So $200 will be debited from your account, and shares worth $200 will be credited to your brokerage account. So that way, your brokerage account will carry two things: money as well as the securities that you have purchased by making use of that money. So all your orders, whether you want to buy some shares in securities or you want to sell some shares in securities, all such purchase and sale orders are going to come from you, originate in your mind, and then they are going to go through the broker to the stock exchange, Trinidad and Tobago Stock Exchange, or any stock exchange in the world, uh, generally speaking. So the brokers act as your agents on your behalf. They carry out your orders. Now, when they carry out, so somebody from the brokerage house is then going to get dressed and get ready, and then go to the stock exchange, Trinidad and Tobago Stock Exchange, because brokers carry a membership of the stock exchange. No one can carry out their business in the stock exchange unless they are members of the stock exchange, and brokers are members. They pay a hefty fee to get that membership, right? So a broker or some employee of theirs is going to take the order that you have placed with them to the floor of the stock exchange to get that order filled. And then when they arrive at the stock exchange, they are carrying an order with them to buy, let's say, 5 shares of Republic Bank Limited. So now they are looking at what I call, quote unquote, trading posts. Trading posts. They are just like counters, right? These days, these trading posts have been replaced by what we call as electronic monitors, so everyone can see the buying and selling prices. So they are going to look for a category of people who will be known as dealers. What do dealers do? Dealers are people on the floor of the stock exchange who stand ready to buy shares from you through the broker or sell shares to you through your broker. So when somebody from the brokerage house goes to the floor of the stock exchange, they are going to get in touch with somebody who deals in buying and selling Republic Bank shares. If it is that you wanted to buy and sell shares for Caribbean Airlines, maybe, then so that brokerage guy would go and find somebody who deals in buying and selling airline shares, maybe. Or if your order was to buy or sell something related to the pharmaceutical industry, then your agent in the form of the broker, would find somebody who deals in shares or securities of the pharmaceutical industry. So, because these guys deal in these particular securities, that's why the name dealers. Folks, if you have your writing material handy, or if you think you will be able to remember it, please listen to this carefully. Dealers have alternative names. They are also known as specialists. Specialists because they specialize in dealing with a certain category of securities. So if I am a dealer who deals with airline shares, I do that day in and day out. And therefore, I'm a specialist in doing that. I know everything about the airline industry. So because I'm doing the same thing over and over again every day, Therefore, I get specialized knowledge about what I do. So that's why I can be called a specialist as well. Ladies and gentlemen, another name for dealers is market makers. Market makers, M-A-R-K-E-T, market, and makers, M-A-K-E-R-S. Why they are called market makers is because they make the market for a particular security. Because if there are no dealers, then you have a desire to buy some shares or securities. You express that desire to your broker. The broker goes to the stock exchange, but then there is nobody dealing in those particular shares, so the market will not exist. Because for a market to exist for a certain thing, two sides to a transaction must always be there. There should be someone who's willing to sell, and there must be someone who's willing to buy. So if you have a desire to buy, someone should be there who should have a corresponding opposite desire, and that is to sell, and that person would be the dealer. Because just like you have a desire to buy, someone else might have had a desire to sell, and then they would have gotten in touch with their broker, and their broker would have placed a sell order with the same dealer. And so the dealer sees now, oh, so I have a buy order from this gentleman, and I have a selling request from this lady, so I can match these two orders and get the deal done. So by through dealers, a market is created for those particular securities, and that is why we call them market makers as well. So please remember from now on that dealers are also known as specialists. They can also be called market makers. So in an organized exchange then, which is a tangible market, trades are conducted through brokers and dealers. But if you have been following the news lately, I was reading that now Trinidad and Tobago Stock Exchange has also started electronic trading or online trading through their platform known as TOP, Top. So that's an electronic trading platform known as TOP, initiated by Trinidad and Tobago Stock Exchange. Right, so you can do the trading from the comfort of your home as well. That is what it is intended to facilitate. So on this slide, you see a couple of examples of stock exchanges. You see an example of the biggest stock exchange in the world, New York Stock Exchange. Their website is nyse.com. And then, of course, you see our domestic stock exchange here, TTSE. Its website is stockx.co.tt. Right. So if, ladies and gentlemen, the secondary market can be classified into two markets, let's just step back a little bit. We are still classifying financial markets according to issue, and we said that there is a primary market for IPOs, and then there is a secondary market for subsequent trading of shares that were initially created in the IPO process. And then we said that secondary markets exist because they provide liquidity, and by doing that, they make the securities more desirable for trading. And then we went on to say that the secondary market can be classified further into two parts. The first one was organized exchange, where I said that it's the tangible part of the secondary market. And then if there is one part which is tangible, it follows that the other part is going to be intangible. And that is what you're seeing now on your display. We call that the over-the-counter or the OTC market. It is intangible, ladies and gentlemen, in the sense that like you could associate one particular street address for an organized exchange, you cannot say that the over-the-counter market exists in Port of Spain only. You cannot say that the over-the-counter market exists in San Fernando only. You cannot say that over-the-counter market exists in New York only. Ladies and gentlemen, over-the-counter markets are dispersed in cyberspace. Cyberspace means that in the over-the-counter market, dealers at different locations stand ready to buy and sell securities, and they are interconnected through computer networks. So there are no one single location in the sense that we had for organized exchanges. One prime example of over-the-counter market is the foreign exchange market. For example, I need to travel to my home country, let's say, and for that I need to buy some US dollars. It's up to me now whether I get those US dollars from Republic Bank Limited. I can conduct my transaction through them, or through Scotia Bank, or through First Citizens, right? Or even the massive financial holdings are also offering US dollars. By the way, they are doing it at $8 per 8 TT per US dollar. So if you're not getting it from the bank, you can approach them to buy US dollars in case of an emergency. Um, so there are various places I can go to, various people or various entities or various foreign exchange dealers willing to buy and sell foreign currency at various locations, different locations, ladies and gentlemen, no one centralized location. So therefore, Forex market is one example of over-the-counter market. Ruben, you say madness. Yes, boy, that's real hefty. And just imagine if TT dollar was to be officially devalued. Nadine, you're saying check Charlotte. Oh well, I'm not going there. uh, Not at this time of the day, at least. Um, let's come back to the safety of my office, and you in the safety of your homes. Folks, towards the bottom of this particular slide, you will see an example of the over-the-counter market. It's an acronym. We pronounce this as NASDAQ, but it has a full form. If you have your writing material handy, or it should be there in your textbook also, or also in the notes that I give to you. The full form is National Association of Securities Dealers Automated Quotation. I'm using a touch. I don't know if I will be able to write in the chat box using that, because I can then give you here national. I don't know whether I'm in the chat box or not. Yeah, I am. So National Association of Securities Dealers automated. I don't know what I type now because can't see what I'm typing. So maybe there's a spelling mistake. Excuse me for that. Automated quotation, Quotation. So that is what it stands for, NASDAQ. So this was supposed to be automated. Automated. So that's the full form. So, right. Did you get my message? National Association of Securities Dealers Automated Quotation. That's what NASDAQ stands for. So NASDAQ is in the United States of America. Most examples that you will see in this textbook are from the US of A, because this book has been written by US authors and published and printed there. Mario, you're saying something, sir. Would top be over the counter? I don't know as yet, Mario, because I have to get into it. The news just came out a couple of days ago, so I have to see. But my suspicion is that it is not an over the counter market, because it is categorically linked to Trinidad and Tobago Stock Exchange, right? So once we link it to Trinidad and Tobago Stock Exchange, we know that it's a centralized location. It is just to facilitate the investors to conduct the business online. That's it. But it is still being done at a centralized location. That particular terminal, the top terminal, it's not distributed all over the country. It is housed in the TTSE. So therefore, my suspicion is that it still continues to be a part of the organized exchange and not the over the counter. Because for it to be over the counter, the same terminal have to be distributed at many places throughout the country, and every dealer could quote a different price then. Remember, when there are dealers for a particular commodity, they can all quote different prices for the same product. So that's not what's happening in the case of TTSE. Right. So, ladies and gentlemen, a few minutes ago, I told you that when we were talking about the fact that secondary markets promote liquidity, I told you keep this thing in mind because soon you are going to come across a question which you will have to ponder upon and consider and give me an educated response on that. So I'm just going to flash that question now for you to see, and I'm going to await your response for a few moments. The question says the companies or the firms or the corporations do not get funds through the secondary market because remember, in the secondary market, only the other buyers and sellers trade in the shares. The company gets its money from the IPO and then it goes home. So if the company doesn't get any money from the secondary market, then therefore they should not be bothered on how their stock is doing in the secondary market. Do you agree with this? That's the question. So if I am company A, I did my IPO, got my money, $20 per share, gone home with that, then later on those shares may be traded in the secondary market by person A, B, C, D, E, F, G, H, whatever. I'm not getting any money out of it because somebody else is buying and somebody else is selling. How am I concerned as a company there? So should I or should I not be bothered how my stock is performing in the secondary market? I don't even know whether you are sure about what's the meaning of how the stock is performing or doing in the secondary market. Ladies and gentlemen, if the stock price is increasing, we say that the stock is doing really well in the secondary market. If the stock price continues to decline, we say the stock is not doing well. So whether the stock is doing well or not doing well, the company, original company, should not be bothered about it because they aren't getting any money out of it anyway. So that is a statement. Now, do you agree with it or not? Ruben, you say it would matter to the original company. Nadine, you're saying if they wanted to issue another IPO, they should be concerned. Okay, I can agree with that, but what is your reasoning behind your arguments? Why do you feel so? Yes, Mario, you want to say something? Please go ahead.
So, aren't like most publicly traded companies' major goal to maximize shareholder benefits?
That's true. And how are shareholder benefits going to be maximized?
Well, yeah, if the share price is decreasing and I'm a shareholder, then I'll be losing money. That isn't particularly
Of course,
in my benefit.
of course, that is true. That's true. So any company, what you're saying is, and I would agree with that, is any company who is following the goal of wealth maximization for their stockholders will be concerned on how the stock is performing in the secondary market, because stock price going up will add value to the stockholders' wealth, and stocks going down would take the value down. So let me see the chat box. Uh, if share price decreases, there's less profits from the brokers and investments banks to make on them. Yeah, because this would affect whether the investment banks buy the original IPO. Original IPO, how is that, Ruben? Because original IPO has happened before the share came to trade in the secondary market. So that is already done and dusted. Maybe you meant a subsequent IPO, just like Nadine mentioned. Yes, Mario, you want to say something? Please do. Oh, okay. Right. Uh, Ruben, you want to get a mic? Yes, you should. It's a good investment. Don't get a mic, Ruben. If you want to go for it, buy a headset, actually. There are some good headsets out there. They can, if you're not speaking to somebody over Skype or something, then maybe you can use it to just listen to music. Get a headset that's more inclusive. That's a more inclusive apparatus, I would say, rather than just getting a mic. So, because companies do not get funds through the secondary market, they should not be bothered how their stock is doing in the secondary market. We categorically deny this statement. We say that this is false because there are two statements, two reasons for that. and you can see them here. Secondary markets, ladies and gentlemen, as we outlined earlier, perform two important functions for the company. One, they provide liquidity to the security, making it easier to sell subsequent IPOs. Now hold on to that thought. There is this guy who missed the bus, remember earlier, did not participate in the original IPO. And then the share price increased from 14 to 40. And he said, oh God, if I would have been a little more alert at that time, and if I took the right advice, I should have participated in that IPO. Now it's going to be difficult for me to purchase the share from the secondary market. It's simply become too expensive. Now this means that this guy who missed the bus and more people like him are just ruining the opportunity that they did not participate in the IPO. And should another IPO come, they are going to rush. And the new shares, if any, issued through a subsequent IPO are going to be sold like hotcakes. Immediately, the new IPO is going to get subscribed. Just like in the case of FCB, the first one itself was oversubscribed. So if the shares have been liquid and they have been performing well, it is going to make that much more easier for a company to sell their subsequent IPOs. So they will continue to monitor what's happening to the price of their shares in the stock market. And then that leads us into the second point. It says they influence the price at which the new issue can be sold. If once the company knows that their shares are too much in demand and very popular in the secondary market, then they can afford to charge a little premium in the new IPO, isn't that so? They know that the real worth of the share is maybe $10, but they say, okay, we are offering it for let's say $15, which is still cheaper than what you can get it in the secondary market for. In the secondary market, it's selling for $40. And we are selling it to you, something that we have created, $10 worth, we will sell it for 15 or let's say $20 even. So they can charge a little $10 extra premium on that. So they can the fact that their share has been doing well will influence the price in the new issue. And if their share has been the demand for the shares that were created in the original IPO, the demand for that has been lackluster, they have not been in demand, then they will have to sell the new IPO at a discounted price. So we have something worth $10, but if you buy, we can sell it to you for maybe $7 a piece. So that's what we call a share premium or a share discount. If you want to correlate this with your balance sheet, if you are an accounting guy or likes to look at balance sheets or income statements, then you would realize that if you look at the equity portion of the balance sheet, there is a certain item there which says capital contributed in excess of par value. So that is what this second point is all about. So if the par value of your share is, let's say, $1, and then you charge $10 for that particular share in the IPO, then against the line item common stock, you will write $1 multiplied by whatever shares, and in the line item capital contributed in excess of par value, you will write $9 multiplied by whatever number of shares are there, because $9 is the extra amount that you're charging based on the knowledge that your shares will sell like hotcake. Right, so this takes us to the end of the first section of this particular chapter, and that will be through looking at some international versions of securities, internationalization of financial markets. Primarily, we are going to be talking about international bond market, in which you can come across broadly two types of international bonds. The first one is known as a foreign bond, ladies and gentlemen. First, listen to me carefully, and then I will flash the definition for you. In case of a foreign bond, it is the intention of the issuer, where the issuer means somebody who is going to sell the bond. It is the intention of the issuer to sell that bond in a single foreign country. Only it's meant for only one foreign country, and therefore the bonds that are going to be sold in that foreign country are going to be denominated in the currency of that country. I hope you have heard me carefully. if you are creating a bond with an intention that it is going to be sold abroad in one single foreign country, and therefore it is going to be denominated in the currency of that particular country only, then such a bond, such an international bond, is known as a foreign bond. On the other hand, ladies and gentlemen, if you create a bond and you intend to sell it in more than one foreign countries, and because you're going to do that, then you try to keep it simple. You say, I'm going to create a bond and I'm going to sell it in country A, country B, country C, but then I'm going to keep the bond denominated in the currency of my own country. Then such a bond is known as a euro bond. Euro bond, EURO, has got nothing to do with the currency called euro. It's simply a name, euro bond. So there can be a foreign bond and there can be a euro bond. Now I'm going to flash both definitions there. Please pay attention to the differences. There are subtle differences. Make sure that in an examination type situation, you don't mix up the two. So I'm going to be quiet for a few seconds. You go through what you see on the screen. After you have read these two things, if there is a question or if there is something that is not clear, please do ask me. Is everyone all right with it? Folks, we are okay with this? All right. Okay, Shana. Okay, Daniel. Thanks for the response. Yes, Tyrell. Thank you. Shalice, Rivaldo. Response acknowledged. Right. So what you have seen thus far is that when we start talking about internationalization of financial markets, we have started off that thing with a couple of international bonds, which we have classified into foreign bonds and euro bonds, depending on their characteristics. There is also something known as a euro currency. Now, I'm again telling you to be careful here. I'm not saying this as euro as a currency, which is applicable in eurozone. For example, if you travel to Netherlands or if you travel to France and you have to pay something in euros, that's not what I'm talking about. I'm talking about euro currency as a single word, one single word without any gap, euro currency. So now again, listen to me first, and then I will flash the definition. Then you correlate what I'm saying with that definition. Folks, if you happen to be a company in Trinidad and Tobago, or maybe it is the TT government, whosoever you are, whichever economic entity you are, and you decide that some of your money you are going to deposit in a bank outside Trinidad and Tobago. So if we could open a TT dollar account in a foreign country, then that account would be known as a euro currency account. Just like we can open US dollar accounts in this country, US dollar accounts are euro dollar account. Do you get the point? Euro dollars are deposited in those accounts. They look like US dollars, but their official term is euro dollars because they are deposited in a bank outside of the United States. So with that backdrop, look at this definition. Euro currencies are currencies deposited by national governments or companies in banks outside their home market. This applies to any currency and to banks in any country. So if TT dollar was a hard currency, and when I say hard currency, I mean to say a currency which is internationally valid. You could use that currency anywhere in the world. TT dollar cannot be used outside Trinidad and Tobago, so it's not a hard currency. If it was, and if you could open a TT dollar account in another country, then it would become a Euro TT dollar account. Right, so from the debt market perspective, we have these international variants, foreign bonds, euro bonds, and euro currencies. With the stock market, well, we just have a couple of comments here before we close off this section. We are saying here that the US stock markets are usually the largest stock markets in the world, but at one time, Japan used to be the largest. Actually, I'm going to show you the current scenario just in a moment. I'm going to skip this slide. I'm going to show you this one. This is the latest information in March 2020. These are the largest stock exchange operators worldwide as per their market capitalization. Ladies and gentlemen, before we go into this, I just want to know from you, do you know what is meant by market capitalization? Just tell me yes or no so that I know whether to explain this or not. Do you know what is market capitalization? Okay, so the moment I see one response which says no, it means it's my duty to explain. So thanks for your response. Ladies and gentlemen, market capitalization is a fashionable word to express the fact, just like to express a simple formula, price times quantity. So if I'm a vegetable vendor and I say that one apple is for $2 and you tell me that you want to buy three apples, then it means how much dollars you are going to pay? $6. 3 multiplied by 2, 6, and that 6 is the market capitalization. So in the context of a financial market, this would mean price into quantity means price per share multiplied by the number of shares outstanding in the market. So all the shares that there are listed on these stock exchanges multiplied by their prices, if you take them as an aggregate, as a total, they will give you the market capitalization of that market. Likewise, one can also calculate the market capitalization of a company. So if my company has 1,000 outstanding shares and each share has a market value of $10 each, then the market capitalization for my company is $10,000. So it's that as simple as that. Right. So if you see on your display, you will still see in terms of market capitalization, in terms of no problem, Shaina. In terms of market capitalization, by March 2020, New York Stock Exchange, United States was number one, followed by, you see, NASDAQ. This is an acronym you came across a little while earlier. I explained the full form to you a little while earlier. National Association of Securities Dealers, automated quotation. So NYSE number one, NASDAQ number three, followed by Japan Exchange Group. Number three. Number four was Shanghai Stock Exchange in China. Number four, Hong Kong Exchange. Number five, Euronext Exchange. It's a combination of exchanges in Europe. Then again, China comes in, Shenzhen Stock Exchange, China, followed by LSE. LSE stands for London Stock Exchange, London Stock Exchange Group in UK and Italy. Then we have the TMX Group at number 9, that's in Canada. And at number 9 is BSE. BSE stands for the Bombay Stock Exchange in India. So these are the top 10 stock exchanges in the world at the moment. Right. Let's change the flavor of tonight's presentation a little bit. Let's move to something known as flow of funds, because that's what we have been talking about really for the last couple of sessions. We have been saying right from the word go that funds continuously need to flow in the financial system for the economy to remain healthy. And now at this point in time, what we are going to do is we are going to see that funds can flow within the financial system in two ways. One of them can be called the direct flow. The second one can be called the indirect flow. To explain this to you as quickly as possible, I have taken the liberty of copying and pasting a diagram from your textbook. So if you see it graphically, that is going to be, I guess, faster for you to make sense of it. So I'm inviting your direction to the green box, which says lenders and savers. is comprised of households, business firms, government, foreigners, etc. Funds leave from them, they pass through the financial markets, and they arrive at the purple box, which is comprised of the borrowers and spenders. This line of flow of funds is known as the direct flow. I don't know why your book chose to call it direct finance, but it's a direct flow of funds. So if the lenders and borrowers can transact directly without the help of any intermediary in the financial market, then it's a direct flow of funds. But see the orange or yellow, I don't know how it appears on your screen, the orange or yellow arrows, the funds are routed from lenders to the borrowers through financial intermediaries or financial institutions. If that is the case, then that is known as an indirect flow of funds. So as simple as that. So if lenders and borrowers can get in touch with each other directly and conduct their business directly without any third party's help, then it is direct flow. Otherwise, if financial institutions or intermediaries are in the picture and they act as connecting links, then it is an indirect flow of funds. To understand this better, please engage yourself in a self-check exercise as follows. There are 6 options given to you. You just have to classify them as direct flow of funds or indirect flow of funds. Let me see what opinion you have on that. For example, number 1 is you purchase shares. What do you think? This is direct or indirect? What is your thought on number 1? Someone is saying indirect, someone is saying direct. Okay, so there are more votes for a direct flow of funds. Though I will tend to agree with that, but I'm not going to entirely dismiss the response which said indirect. Who said that? Nadine said indirect, I guess. Shalise also said indirect. Renella said indirect. So, well, since you have to go through brokers, yes, I would agree to that logic. But because there's a difference of opinion in literature, Nadine, and others who said indirect. Sometimes the opinion is that because the brokers are your agents, it is basically you who is participating. They are your agents. You have told them to do so. It is not as if a third party came and tried to establish a connection. You expressly instructed your broker to go ahead and buy this for you or sell this for you. So the argument is that it is basically you doing it. And because it is you and there's no other intermediary in between, then that is a direct flow of funds. But there are some arguments which say that a broker, because they are your agents, and then not only brokers, then you have to pass through the dealers as well. So there is a chain between you and the actual seller of the on whosoever is on the other side of the transaction. There are intermediary parties in between. So it's a indirect flow of funds. So both arguments are there. It depends on what you're subscribing to. There's no real right or wrong answer specifically. Number 2, so you might have a question at this point. You might say, so what in an exam situation, if you write direct flow funds or you write indirect flow funds, are you going to be penalized for that? So the answer is you're not going to be penalized unless you are giving your reasoning. So as long as your reasoning is there and I'm in agreement, everything is okay. Number 2 is you put money in a fixed deposit in a bank and the bank offers a loan to someone else. This appears to be clearly an indirect flow of funds from you to somebody who's taking a loan. Now you don't know that somebody, but the money is passing through an intermediary, a bank. Therefore, it appears to be an indirect flow of funds. Would you agree with that? Okay. All right. So at number 3, you buy bonds, which is the same thing again. You could either consider it as direct or indirect, depending on which argument you believe in. Number 4, you have an account at a credit union and another client takes a loan from the credit union. It's similar to number 2 there. So it's an indirect flow of funds. Now, number 5, a bank purchases share. An intermediary, a financial institution, is purchasing shares. What do you think of that? I would gravitate more towards a direct flow of funds in this case because an intermediary is already doing what it needs to do. Uh, uh, Side question: are there brokers and dealers in Nasdaq? Mario, there are dealers in Nasdaq, no brokers. No need for a broker because everything is there online, interconnected. So when you, for example, go to a bank to buy US dollars, do you have to go through a broker? No, you're simply approaching the dealer on your own because the bank deals with foreign currency and you go there and do your business. There is nobody in between. A bank purchases shares. I would like to think of it as a direct flow of funds, but then you might have a different opinion. If you have, you can give your reasoning. Number 6, a finance company lends to a customer by borrowing from a bank, and then that becomes indirect. So wherever we find financial institutions playing a role, they become indirect flow of funds. So this is a loose classification that I've done. You may or may not agree with it, but if you don't agree with it, then please be kind enough in an exam situation to provide your reasoning why you don't agree. Right, so can we proceed, ladies and gentlemen? All right, great. We now approach the third section of this chapter, and which also means that this is going to be the final session for topic 1, and that is going to deal with the role and functions of financial institutions, also known as financial intermediaries. It's not going to take too much time. Maybe we should be done in about 12 to 15 minutes or so, maximum. So when we begin to think about the role and functions of financial institutions, also known as financial intermediaries, then our attention should go to 2 or 3 important facts, and they are mentioned on your display. The first one is that financial institutions, I just chose to write as an abbreviation, FI, means financial institution. So financial institutions engage in the process of indirect finance and are therefore more important source of funds or finance as compared to securities markets. Let's stop here for the time being and think about it. Whenever you and me, most of the citizens like us, we are in need of money, either we need to deposit funds so that our money grows at a certain rate, or we need to borrow funds so that we can maybe finance our education or buy an asset or something. Where do we think about going to in the first place? What's the gut feeling? What's the first instinct? What's the impulse? Do we ever think about going to the stock market, or do we ever think about going to the bond market, or do we ever think about buying treasury bills from the treasury? What do we think about? Let's go to the bank. Isn't that so? And what's a bank? It's a financial institution. Most of the citizenry thinks about financial institutions and not financial markets whenever there is a need to transfer funds from one end to the other. So therefore, financial institutions are a very important factor in the financial system in making that transfer from point A to point B possible because they engage in indirect finance, and that is what is most popular with the general public out there. Well, you and me might have a little bit of knowledge about financial market. We may know what's a stock and what's a bond, but not all people have that knowledge. For example, there are engineers, there are doctors, there are people who can't read or write well, but everybody has need for money and finances to carry on with their lives, and not everybody is good at understanding financial terminology. So they will not be thinking about stock market or a bond market, but everybody knows what's a bank and what it does generally. So that's one reason, that's one role a financial institution plays, that it provides a means through which funds can continuously keep changing hands through the financial system. The other reason, which you see on your display, is equally important. It says financial institutions are needed because they reduce or they mitigate or they take care of two very, very important problems. Number one is they reduce transaction costs, and number two is asymmetric information. We will talk about asymmetric information when we get there, but let's talk about transaction costs at this point in time. Financial intermediaries or financial institutions, ladies and gentlemen, take care of transaction costs to a large extent. How? They do that through two ways. Number one, they reduce transaction costs through their expertise, and number two, they can take advantage of economies of scale. Let's just think about a bank, for example. Uh, I can give you my own personal example. I wanted to replace my vehicle a couple of years ago, and I'm just a teacher, so I'm not a multimillionaire or somebody who just has the ready cash lying there in a bank account, and I can use that to buy a new vehicle straight away. So I approached the bank for borrowing some money, taking a vehicle loan, and the loans officer, well, they did their checks and balances. They asked me for all the documentation, where I work and how long is my contract for, and what are my assets, what kind of an accommodation do I live in, is it rented or is it my own place, do I have a credit card, have I taken any other loans, and so on and so forth. The different type of credit checks they would go through. But before doing that, the loans officer told me that there is no problem. We can sanction you a loan at this rate of interest, and you can come maybe a day or two later to complete the paper formalities. So no checks and balances were done at that time, but she gave me the undertaking that there is absolutely no problem. And after the deal was done and I had provided all documents and the loan amount was credited to my account, I asked the lady, the loans officer, how did you make up your mind so fast about the bank being ready to give me a loan? You had not seen my documents, you had not seen any paperwork, you had not asked me anything. And she told me that she has been in this business for over 25 years and it's getting close to retirement for her. And she told me that a way a person walks into her office, she can make out whether this person is going to be a good credit or a bad credit. So experience, expertise in doing the same thing over and over again makes you good at what you're doing. So she could just make out from the way I went into the office and talked to her that I look like a reasonable person and I will not be defaulting on my loan. Mario, you find that amusing. Uh, yeah, and then uh, no, that's not sketchy really, because the fact that she gave me an undertaking that the loan should be able to get sanctioned without any problem does not translate into the fact that she did not check all my paperwork. She did that later on. So all papers were in order. I provided everything, and then the quotation or the invoice from the car dealer was there, and everything was done. The legal fees and the lawyers were there. Everything was done. So it was not to say that the due checks and balances were not done. It was just that her gut feeling came out to be correct, that I would be a good credit. I have since then paid off the loan. It was a 5-year loan. I paid it off in 3 years, because why to keep paying interest? You learned about loan amortization in FM1. You know that when you start paying off the loan, it is the interest that you are paying more in the first few installments, not the principal. Um, but I got the loan before checks and balances were done. Not so. No, Mario, I just got an undertaking. No money actually got credited to my account. Yeah, it was just a verbal undertaking. She said it should be okay. Just come with your documents. All right. So we have talked about expertise. What about economies of scale? So Mario, you seem to be really suspicious of me. So I'm addressing this to you specifically. Let's say I ask you for He wants to know how you walked in. For that, you will have to meet me someday, and I'll have to show you the catwalk. Uh, uh, so, Mario, I'm addressing this to you specifically, but others can, of course, listen in. Um, let's say, Mario, I am in dire need of $10,000, and I say, okay, I happen to know Mario from class, so let me ask him for help. So you also say, okay, I know this is my lecturer and he should be a good credit. He should not be running away with my money. But then who knows? This Dr. B with the person with a strange name, something that we can't even pronounce properly. What about his credibility? We don't know anything else. We haven't even seen the man's face, just a photo. And that could also be of somebody else. Who knows? He looks like that also or not. So I'm not going to take my chances. You think, well, it might not be rude to refuse a lecturer. So you would like to help, but at the same time, you would like to protect yourself. So you get in touch with a lawyer, and together, your lawyer and yourself get an agreement or a contract drafted that if Dr. B happens to take those $10,000 and run away, maybe if the borders open, he gets on the plane and is gone to his home country. What is our recourse? What can we do? Can we extradite him from India back here and try him in a court of law? Or should we ask him to keep something as a security with us so that even if he runs away with the money, then at least we can sell that, recover our money from that? Some kind of a contractual agreement. And also the rate of interest and everything is mentioned in that, and the term of the loan is mentioned there too. So the lawyer says, okay, my legal fees for helping you draft this contract and making it a legal document is, let's just make up something, maybe $1,500. And you say that you're going to charge maybe, let's say, what, 10% on the interest. So what happens if it's a 1-year loan? Principal amount is $10,000 and 10% is the rate of interest. You end up getting $11,000 maybe back. Maybe you get $1,000 as interest, but you end up paying $1,500 to the lawyer as legal fees. So actually, you end up losing on your lending. Imagine now, in case Mario, if there is a bank making a lending decision, they are going to, of course, just like you got in touch with a lawyer, the bank is also going to get in touch with a lawyer because they also give out loans to people. So what they are going to do, they are going to get a standard template of a legal contract and they are going to pay the legal fees, whatever it is. Maybe it's a bank, so the lawyer will charge more. Maybe they will charge $5,000. So that's okay, no problem. Bank says it's a standard template. So people come, the same template is used once, twice, thrice, 4 times, 5 times, many times the same template is going to be used. So then what is the per unit cost of per unit legal fees that the bank ends up paying? Maybe a couple of cents per loan that they are making out. So that leads them, because they are doing the same thing on a much larger scale as compared to an individual, they are in a position to enjoy economies of scale. And because they develop expertise in doing what they're doing, because that's the business they are engaged in every day, so they are able to reduce the transaction costs. Once, ladies and gentlemen, the transaction costs are reduced, the banks or the financial institutions will be able to provide you with two important services. Maybe you have used these services, you have been using them, but maybe you're not aware of them. We can classify them into two parts. One of them is known as liquidity services. A liquidity service, guys, means that a bank tries to make it easier for you to conduct your transactions by facilitating, say, a lot of various ABMs in various locations. Maybe enabling you, maybe creating a smartphone app which you can install, and just by sitting at your home, you can pay your bills and do whatever, transfer your funds. These are all liquidity services. To develop these services costs money. And where do they get the money from? Remember, they are saving some transaction costs and they will transfer some part of that saving to the customers in the form of liquidity services, any service which will make it easier for you as a customer to conduct your transaction. So this is liquidity services. A lot of material to read, but I've already talked about it. So maybe if you revisit the recording, you can just pause on this slide and look at it. But the essence of that, I have already given it to you. So in the interest of time, maybe I can move on to the next slide. What say? So because they are saving on transaction costs, they are able to provide you with liquidity services, and they can also do another thing for you. If you are in a category, if you are someone who is looking to invest your saved money, like for example, there are many people who want to invest somewhere, but they want to keep their investments safe, but they don't know which investment is going to be safe, and yet at the same time, they don't like to keep their money or savings idle. So what the banks and financial institutions can do for you is that they can share the risk of your investment. This is known as risk sharing. What they will do is, like for example, let's take the example of another financial institution, a mutual fund company. Let's think about UTC, for example. What they will do for you, they will ask you probably to buy some units in the mutual funds. The per unit cost of buying the unit is not much. Maybe you can invest $500, $1,000, maybe 2,000, 3,000, depending on your capability. So likewise, they are going to collect these small amounts from a lot of people, and they will have a big trunk, big load of money, big set of money with them. And that set of money they are going to invest out there in the market. They will create a portfolio. They will invest some of that money in stocks, some of money in bonds, some of money in maybe gold, some of money in oil, some of money in real estate maybe. So they are going to have a distributed portfolio. So if you did that on your own, that would have meant you taking a lot of risk, because you're not aware of all type of markets and you're not an expert really, but you are taking the help of an intermediary, a mutual fund in this case. So your per unit investment and your per unit risk is much more limited as compared to the risk that the mutual fund is taking on, because it is collecting all of that money and investing a big set of money in a diversified portfolio out there. So in a sense, what they are doing is they are transforming the assets for you. So those stocks, those bonds, those that gold, that real estate, that oil, all those various type of investments, high risk investments, they are going to get transformed from high risk to low risk. High risk to low risk for you. I need your consent on a few items to continue. I don't know why this phone, what kind of consent it needs from me. I don't want to give you any sort of consent. Don't steal my information from my phone, whoever you are. Yeah, same thing. I don't know. At this time, some Samsung services known as Bixby, somehow it becomes voice activated. Yeah, tech savvy people. Yeah, if you can help me in turning that off. I don't know how to turn off these Bixby services. Right, so basically, this is what is happening. I was narrating you a story of asset transformation and the fact that financial institutions will be able to share risk. So this is what you can read as part of your examination material. What it says is low transaction costs would help reduce the exposure of investors to risk through a process called risk sharing, where financial institutions would create and sell assets with lesser risk to one party, that is you, in order to buy assets with greater risk from another party, that is the financial market out there. This process is referred to as asset transformation because, in a sense, risky assets are turned into safer assets for investors. All this they can do because they're saving on transaction costs. Folks, this takes us into the absolutely last thing. Remember, if I go back a couple of slides, if you read here, you came across a term called asymmetric information. That's the last thing that we need to talk about tonight. So this is where we are now. Folks, asymmetric information can be further divided into, as you can see on the slide, two things: adverse selection and moral hazard. Very easy to follow and understand. But first of all, what is asymmetric information? For a moment, ladies and gentlemen, close your eyes and visualize a bell curve. If you know about a bell curve, also known as a normal distribution, you know how it looks like. It divides. There's a line right in the middle, right smack in the middle, which is the mean of the distribution, as they say. But what it does is it divides the curve into two exactly symmetrical parts on the left-hand side and the right-hand side. So assume that that bell curve is the information, and that line in the middle is dividing the information into two symmetrical parts, left side and right side. That would be symmetric information. In our context, it will mean that this left side of the bell curve and the right side of the bell curve, there are two people there. On the left side, maybe there is a seller. On the right side, maybe there is a buyer. Or on the left side, maybe there is a lender. On the right side, maybe there is a borrower, or any other party who could do a transaction of any kind: lending, borrowing, buying, selling, whatever. So if there are two parties to a transaction and they both have access to the same and equal information, we say that that's an ideal condition for a transaction to happen. That the result is going to be the most fair transaction possible, because the information is equally available to both parties. But in the real financial world, nothing like that happens. Financial world is characterized with asymmetric information, where one party always knows more than the other. For example, just take a simple example. Think about it. You're going to buy health insurance, for example. You have to fill up a form. Do you have any current ailments? You write, even if there is something minor, I mean, you will say no, because you don't want saying yes, because if you do, the premium will go up. Do you have any risky habits? You say no, 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 no. Do you smoke? No, 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 not at all. Do you drink? No, no. Carib doesn't count, for example. So everything is a no, 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 no. You are the ideal guy going for the this thing, the insurance policy. To check that, the insurance company may ask you to come up with some blood tests and urine tests and some x-rays and all of that, but that doesn't reveal everything really. So if I have a tendency to get, let's say, allergic asthma, it will not show up on my x-ray unless I'm going through a season where I will feel asthmatic, isn't that so? So nothing will show up really. But then when the season comes and I feel asthmatic and I'm short of breath and I visit the doctor and they say you have to buy this inhaler and you have to buy this tablet and you have to do this, then I will put up a bill to the insurance company for reimbursement. So, ladies and gentlemen, that's an example of asymmetric information where I know more than my insurance company. I hid some facts deliberately. So, like this, asymmetric information, for ease of understanding, we can divide that into two parts. One is adverse selection and one is moral hazards. What does adverse selection mean? Adverse selection, first thing you need to remember, don't forget this, it always happens before the actual transaction takes place. You have already made up your mind, you have already taken a wrong decision. That's adverse selection. For example, there's a friend of yours, he keeps hounding you for a little $10 help, little $20 help, little $30 help. Most of the time you refuse him or her, but then he or she is persistent, and then one of these days you're sitting in an important meeting or you're going through a class and your phone begins to ring, and there's on the other end of the line there's the same friend asking for a little $50, and just to get him out of your just he's getting onto your nerves, and just to get him out of your this thing system, you just say, okay, let me do what I'm doing, I will give you the $50 you need, just leave me in peace for now. You have already taken a wrong decision, because those $50 are not going to come back, because that friend of yours is not a good credit. He has a history, or she has a history of taking those little amounts of money and then not returning them to you. But what you have done is, for whatever reasons, you have made a wrong choice. You have made an adverse selection, which means that the potential borrowers who are most likely to produce adverse outcomes are the ones who will most likely seek the loan and get selected. Just like in this particular case, your friend's persistence paid off rather, and he or she was successful in getting some financial help from you. So the result of adverse selection is that you will be selecting bad credit and reject a good credit. You will take a wrong decision. That is adverse selection. What about moral hazard? Moral hazard, ladies and gentlemen, is something that happens always after the transaction. It's a danger, or it's a prospect that the borrower may have incentives to engage in undesirable or immoral activities. Immoral here doesn't mean morality from a standard point of view. It means financially immoral. Immoral activities, making it more likely that they are not going to pay your loan back. So the thing that you read on the slide is with the context of the borrower and the lender, but I can take the insurance example forward. So you were about to buy health insurance, for example, and so once you lied on the application form, and the insurance company made a decision to go ahead and decide a premium for you, that was adverse selection from the point of view of the company. They could not find out the lie that you declared on the form. That was adverse selection. They made a wrong decision. After the decision was made and the insurance policy was yours, now you can engage in reckless behavior because you know that, well, you are insured. So you can engage yourself in risky behavior. Oh, I'm going hiking now and it's raining. I don't care. Even if there's a little accident, there's insurance to cover me. Oh, I never smoked before, but I'm going to try. One drag doesn't harm, and then from one drag you go to two and to three and to four, and then it becomes a habit, and you are putting yourself in danger, and the insurance company, if something happens to you, will have to reimburse you partially for whatever ailment you end up with. So after the insurance policy is with you, your behavior can become reckless, knowing that you're already insured. Likewise, if you purchase auto insurance or vehicle insurance, after you have the insurance policy, the likelihood of you driving more carelessly can increase. That is moral hazard. And in the case of borrowing and lending, for example, maybe I can walk into your office and ask for $100,000 loan. I know in my mind that I actually only need about 60, 70,000 for home improvement, but I'm asking you for a loan of 100,000 because in my own mind, I know that the rest 20, 30,000 I am going to spend. I have been frustrated and I've felt pigeonholed and I've felt psychologically ill and I feel dull, locked up in this lockdown, can't go anywhere, can't do anything, can't go out to eat, can't go out for a movie, can't go anywhere, can't do this, can't do that. So the once the borders reopen, I am going to take that 20, 30,000 extra that I'm borrowing and I'm going to book myself a ticket to Cancun and I'm just going to lie there with a pina colada in the pool. So that is immoral, undesirable behavior, which simply means that you are not going to be using the money for the purpose that you are borrowing it for, and that will put the repaying prospects of the loan in peril, in danger. So that's moral hazard. It happens always after the transaction occurs, and the adverse selection happens always before the transaction occurs. As we said before, financial intermediaries reduce adverse selection and moral hazard problems because they have a lot of checks and balances. I told you about my own experience. They asked me everything and asked me to give the paperwork for all the things that they wanted to know about me, thereby reducing the chances that I would lie to them on the loan application. What about moral hazard? I don't know if you have heard the term, but I'm going to introduce this to you. The last thing for tonight is credit rationing. Maybe you heard it, maybe you didn't, but you can search for it on the internet. You will come to know its meaning. Like in the example, if I only need $70,000, but I apply for a loan of $100,000, knowing that I'm going to be misusing 30,000 out of the 100,000, then the financial institution will try and check this tendency of people but through credit rationing. So anybody who's applying for a loan, they will tell you we are only going to finance you 80% of what you ask for. So I apply for 100,000, I'm going to get only 80,000. So that reduces my incentive to misuse the money through, and credit rationing is one of the ways available with financial institutions to try and reduce such kind of problems. That it would be all, ladies and gentlemen, for tonight. We have now completed topic one. First time you heard which term, Nadine? Credit rationing? The first time you heard that? Okay. Credit rat. There's no credit rat. I'm scared of rats anyway. Rationing, yes, yes. Um, uh, all right, folks, this is all that we will discuss tonight. This puts an end to topic number one. Shana, if we are not funny in life, what are we going to do with the long face? We are not going to get anywhere. Um, Before you leave, folks, one request. Next time onwards, we will start topic two. It's going to take us into some computations which will be related to bonds, YTM, and interest rates. And towards the end of that topic, we will do something known as the duration of a bond. So you will need to use the financial calculator extensively. So please be there with your calculators. Tyrell, you're asking about tutorials. I had explained that in the last session we had that we are having online tutorials, not face to face, but I have given you all the tutorial questions that you need to do. They are uploaded on the my e-learning page, and I have also created Google Forms for you. So what you can do is you can solve the tutorial questions and provide your answers in the Google Forms built for you there, and they're available on the my e-learning. And once you have answered all questions, then you will get all the solutions and the feedbacks, right? So like for example, for the first tutorial, I have seen 9 people already did it. About 6 or 7 of them got that question correct. A couple of them got it wrong, but they would have then seen the correct answer as well. So that is the plan with which I'm going, because for me also this is experimental. I don't know what would be the best way of doing this type of an activity when we are so far away from each other. So in any case, if you don't understand anything, I'm just an email away. Or we also have a Telegram group. You can just shoot me a message anytime and we can talk. Any other question, comment, ladies and gentlemen, before we sign off for tonight? All right, then, ladies and gentlemen, I'm disabling the sharing of applications, and I'm going to now close the recording so that you can revisit when you want. Take care, ladies and gentlemen, till we meet again.